About planting mustard seeds that will grow into a mountain of recovery. Well, guess what? The buds are blooming here in the spring. Recovery is coming very soon. Look, today's pending home sales went up again. That's huge. We'll put a picture up on the board. In fact, we might give you a couple of pictures. The entire housing sector probably bottomed in January. Jobless claims are falling. Consumers are spending. Manufacturing orders are rising. The swine flu has peaked. Look at those transportation stocks today, hot as a pistol. The Fed is easy. The Treasury curve is positive and will remain so. And you know what? This point made Friday night by our pal Jerry Boyer. If higher tax rates are indeed coming next year, you want to invest now while the rates are still low and the after-tax returns are still high. There could be a rush into stocks in the second half of this year. It may not last forever, but right now it is the big story. This thing will not stop. The S&P in the green year to date. Let's bring in our market experts. Here's the trillion-dollar man, Robert Dahl, Vice Chairman and Global CIO of Equities at BlackRock. Peter Schiff, President, Euro-Pacific Capital, and Ned Riley, Riley Asset Management. Ned, I want to go to you because I got to ask you, look, commodities hot, banks hot, transportation's hot. You know what one I love, Ned? For all the beaten down in the housing sector, which has been perfectly awful, I'll grant you that, as the numbers now begin to bottom and turn up. Home builders up 10% today, Ned. Home builders up 84% since the bottom in early March. Your thought, what do investors do? Should they get on that train, Ned?
Yeah, they do, Larry. They have to get on the train because clearly, in my judgment anyway, this economy has turned. And I said it a month ago. I said, watch out for the housing area because that should be the leader in the group. And we're seeing it happen. Money is now starting to flow not only into the economy, but flowing into the markets as well. And you and I agreed a couple of months ago to say, hey, that's going to come as soon as people realize that rates are down to 4 3/4 on mortgages. Short rates aren't paying you anything to stay in there for security or safety. And what I really like about the market, Larry, financials are leading. I don't care what comes out on Thursday. The market's already discounted the majority of that. And the market is still extremely cheap based upon what I call a 5-year moving average of earnings. And bottom line is, I'd still buy today.
All right, buy today. That's very important. Bob Dole, let me come to you. Did I mention cheap gasoline prices? The whole energy tax cut is yet another powerful mustard seed. And the stuff that should be happening is happening, Robert. This is what I like about it. As Ned said, financials leading the way. And then followed by classic cyclical indicators, right? Materials, industrials, consumer cyclicals. Let me add transports. I think this swine flu business has definitely peaked out. That seems to be the story. Transports recovered. They had a gigantic day today. What's your take? Is it lasting? Is it durable? Should people rush to get on this train?
People are rushing to get on the train, Larry. There's no question about it. People are covering their shorts, and a lot of people have a lot of money in cash that looked great getting no return when stocks were falling, but now that money's burning a hole in their pocket, and they're trying to catch the train as it's leaving the station. The green shoots continue to multiply. As you say, it won't be a one-way street. You and I both know that, but we have seen the lows.
By the way, Elaine Garzarelli came out with a big bullish piece today. I think a lot of people still follow her, Robert. And I want to ask you, where are you going here? In other words, if you buy into the rally, we'll get to Peter Schiff in a minute, who's going to have a different point of view. Where do you go? Do you buy the stuff that's cheap, or do you stay with the cyclical, pro-recovery, economic-sensitive growth stocks?
I think this will be a rotational move to the upside. We've seen the down and dirty and dead come back to life, the lowest quality names. We've seen the cyclicals join the way. Before this is over, technology will broaden out. We'll even have healthcare join in before it's over, I believe.
All right, Peter Schiff, let me come to you. On the other hand, let us be very realistic here. We saw Obama blasting large corporations, international corporations, wants to raise their taxes. He's waging war on capital. He's breaking the bondholders' contract law, which can't be a good thing for the entire free market economic system. Alan Meltzer, a very distinguished academic and Fed watcher, has a big piece in the New York Times today saying inflation is on the way from lousy monetary policy. Do you throw yourself into that camp?
Well, you're 100% right with what you just said. But where you're wrong is making the leap from thinking that higher stock prices means the economy is about to recover. Look, stock prices are rising all around the world. In fact, the U.S. markets are substantially underperforming. What we're actually seeing is a flight from cash because of all the inflation. And ironically, strong global stock markets is actually a big negative for the U.S. economy in the short run.
How can that be, Pete?
Because as investors want to buy stocks and stocks become more appealing, treasuries become less appealing, dollars become less appealing, and so what happens is we get higher consumer prices and higher interest rates in a recession.
But wait a minute,
and that's going to compound the problem.
I agree with you that treasury rates are rising. Now they are, let's see, they closed today, the 10-year closed at 3.16. The low at the time of the Fed meeting when they announced bond purchases was 2.5. Actually, we're up from 2% more or less. But Peter, I got to disagree with you. I think the history suggests that Treasury rates going up along with stock prices. People are moving out of the riskless stuff and they're going into riskier stuff because corporate bond prices are falling, Peter. So I got a challenge on that.
Well, look, I think for the short term,
corporate bond prices are rising, rates are falling, and, you know, that's good for future profits. That's a good indicator. I want my corporate rates to be falling even while my Treasury rates are rising.
Yeah, but Treasury rates are not going to just rise. They're going to surge. They're going a lot higher, and the dollar is going a lot lower, and this is going to undermine the economy. This is not just Treasury rates going up from 3% to 3.5%. We're going to go to 5%, 6%, 7%. They're not going to stop. I mean,
wow.
and the economic contraction, we've been spared the worst of it because the world has flooded into our bond markets and flooded into our currency, so we've been able to borrow trillions. But when the world understands that the global economy isn't as weak as we painted it, and they want to invest in their own economies, they want to invest in higher yielding assets, the supply of credit dries up for the United States.
All right, I don't know about that, but I hear you. I want to ask Ned Riley, and I want to ask Bob Dole to react, because I want to read you a couple things. Just in today's rally alone, Asia up 5%, Latin America up 7%, China up 5.5%. Rebecca Jarvis noted that the stats coming out of China are improving, especially the...